Welcome to RBC's Markets in Motion podcast, recorded June 16th, 2025. I'm Lori Calvasina, head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The big things you need to know? First, the conflict in the Middle East comes at a complicated time for the U.S. equity market, as our sentiment and seasonality work has been suggesting stock prices could keep moving up, while our valuation, earnings, and GDP analysis have been suggesting that the stock market has gotten a bit ahead of itself. We highlight the three challenges we see for U.S. equity markets here, which we are monitoring closely. Second, we revisit our 4 tiers of fear framework, which helps us map out potential downside in U.S. equities from the conflict, particularly if conditions escalate and broaden. And third, energy and materials seem most likely to outperform if the conflict results in a sustained oil price spike, while consumer discretionary and communication services seem most likely to underperform. We're also keeping an eye on utilities and REITs as potential tactical outperformers. If you'd like to hear more, here's another 5 minutes. While you're waiting, we need a favor. The Extel survey, formerly known as Institutional Investor, opened recently. If you found this podcast helpful, we'd appreciate your support in the portfolio strategy category. Last year, we were honored to rank number 3 in a very tight race, our first time in the top 3. We suspect our podcast listeners did a lot to help us get there, and we'd appreciate your support again. Now let's jump into the details. We'll start with takeaway number 1. What the escalation means for U.S. equities broadly. The conflict in the Middle East comes at a complicated time for stocks, as our seasonality and sentiment work have been suggesting stock prices could keep moving up. Meanwhile, our valuation, earnings, and GDP analysis have been suggesting the stock market has gotten a little bit ahead of itself, keeping us on guard for a pullback. As we've discussed recent developments in the Middle East with RBC's commodity strategy team, 2 key risk factors for U.S. equities have come into focus for us. Their view that the conflict could take some time to play out, and the risk that it evolves into a broader regional conflict. The broader the conflict becomes and the longer it lasts, the more problematic we think it will be for U.S. equities. We see 3 potential challenges which we're monitoring closely. The first of these, historically heightened uncertainty on national security policy, tends to actually put downward pressure on PE multiples for the stock market. The second issue, we're worried the situation in the Middle East could derail the sentiment recovery that's been underway, as seen in a number of recent investor, consumer, small business, and C-suite surveys. We think this issue matters a great deal, as the recovery and sentiment has been one of the most important drivers of recent stock price action. And third, we're obviously watching oil prices. A major sustained spike could impact headline inflation, which our econ team notes could muddle the Fed's inflation outlook. And our own modeling suggests that higher headline inflation could put downward pressure on U.S. equity market valuations. It could also add to angst over growth at a time when tariff impacts may be starting to hit. Moving on to takeaway number 2, how much could stocks get hit? To answer this question, we found ourselves looking back to our 4 tiers of fear framework that helped us navigate tariffs in March and April. Tier 1, a garden variety pullback of 5 to 10%, seems on the table. We've seen this kind of reaction around big episodes in this conflict before. The October 7th attack came in the middle of a 10% drawdown, which had been sparked by a surge in 10-year yields, with half of the decline in that pullback coming after the attack. In April 2024, there were also a series of strikes in this conflict, which occurred against the backdrop of a 5% drop in the S&P 500. Tier 2 and Tier 3 of our 4 tiers of fear framework are not our base case, but they are risk scenarios that we're monitoring. Tier 2 is a growth scare or 14 to 20% decline, which is what we went through in April. If recession fears start to percolate, a retest of the April lows is reasonable to anticipate fundamentally. Also, we've run a new inflation stress test on our valuation model. If we bake in 4% inflation on PCE, just 2 cuts from the Fed, and 10-year yields around where we are now, our modeling points to 4,800 to 5,200 on the S&P 500 as being fair value, depending on what earnings are used, which is basically the Tier 2 range. Tier 3 on our framework is a recession-type drawdown of 27 to 32% on a median and average basis versus peak. Major wars in recent decades, think the U.S. invasion of Afghanistan after 9/11, the U.S.-Iraq wars, and the Russian invasion of Ukraine in 2022, have been associated with recession or looked like recessions in terms of stock market pricing. Wrapping up with takeaway number 3, what do we buy if conditions in the Middle East escalate further? We took a look at the relationship between sector performance and oil prices since 2010. It suggests to us that energy and materials are the most likely to outperform if the current situation in the Middle East results in a sustained oil price spike, while consumer discretionary and communication services are most likely to underperform. Two other sectors to keep an eye on in this scenario are utilities, which was the second best sector performer in the S&P 500 in the 2022 oil price spike. It's also a sector we've been overweight in 2025 as defensive hedge, and earnings revisions have been strong relative to other sectors. We'd also keep an eye on REITs. We've been cautious on this sector, but funds flows are starting to improve. That's all for now. Thanks for listening, and don't forget to vote.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.